Welcome back to the podcast, Generate Income by Selling Options. In the previous episode, we explained how the Greeks affect options and what that means for selling options. We introduced the Greek, gamma, and discussed the effect that gamma has on options. Let's now dive into a Greek that seldom gets discussed, but that every trader beginner or experienced should know about. That Greek is Vega. Before we talk about Vega, as a reminder, please support the channel and subscribe to this podcast in order to stay updated on upcoming episodes. And now, let's bring in our hosts, Adam and Isla.
Welcome to the Deep Dive. Today, we're jumping into a really key concept in options trading, Vega.
Yeah, Vega. Definitely important. And we've pulled together some great material from places like optionstrading.org, Tasty Live, Learn Options,
Verolf Intelligence, Investopedia.
And Corporate Finance Institute, too. A good mix.
Absolutely. So our mission here is to really unpack Vega. What is it? How does it work? And crucially, why should traders care about it for pricing and strategy?
Exactly. We'll try and keep it clear, skip the super heavy jargon, but definitely hit the important stuff.
Sounds good. So let's dive right in. Fundamentally, what does Vega measure? What's it telling us?
Okay, so simply put, Vega measures how much an option's price is expected to change if the implied volatility of the underlying stock or whatever it is moves by 1%.
1% change in IV. So it's a sensitivity measure.
Precisely. Think of it as how much the market's expectation of future price swings affects the option's current price. If nervousness goes up, Vega tells you the dollar impact on your option.
Got it. Now, people always talk about the options Greeks. Vega's in that club, right? But it's kind of the odd one out with the name.
It is, yeah. It's definitely considered one of the Greeks, these key risk metrics, but you almost always just hear it called Vega.
Not like delta or gamma with their actual Greek letters.
Right. You might technically see it as nu in some really academic contexts, but honestly, in trading, it's just Vega. The concept matters more than the symbol.
Okay, good to know. So just Vega it is. Now, when we look at an options price, it has different components. Where does Vega fit in?
Great question. Vega is all about the extrinsic value, only extrinsic.
Also called time value, right?
Exactly, time value. It's the premium paid for the possibility of future price movement and the time remaining for that to happen. Vega has basically zero impact on the intrinsic value.
Intrinsic value being the immediate profit if you exercise right now.
Yeah. So Vega is purely about that what might happen later part of the price, driven by volatility expectations.
Okay, that clarifies things. It's about the potential, the uncertainty priced in. So if I buy an option, a call, or a put, I own it. What does positive Vega mean for me?
Well, if you're long an option, positive Vega is generally what you have. And it means, theoretically, if implied volatility rises, the price of your option should go up too, all else being equal.
So if I think things are about to get choppy, more volatile, positive Vega helps me.
It can, yes. Your option becomes more valuable partly because the market is pricing in bigger potential swings.
And the flip side, if I'm the one who sold or wrote the option?
Then you short Vega, or you have negative Vega. For the seller, if implied volatility goes up, the option's price theoretically increases, which isn't what the seller wants initially, as it makes it more expensive to buy back.
Right. So rising IV makes the option they sold worth more, potentially increasing their risk or lowering their profit if they close a position.
Precisely.
Okay, let's make it concrete. Give me an example with a number. Say an options Vega is 0.20.
Right, 0.20. That means for every 1 percentage point increase in implied volatility, say IV goes from 25% to 26%, that option's price is expected to increase by $0.20 per share.
20 cents per share. And since options contracts are usually 100 shares.
That's a $20 change in the contract's value. So if IV goes up 1%, the contract price goes up by $20. If IV drops 1%, the price drops by $20.
Okay, $20 per point of IV change. That definitely adds up, especially if IV makes a big move.
It really can. It shows how volatility shifts directly impact the option's P&L.
So what drives Vega itself? What makes it higher or lower for a specific option?
Several things. So a really big one is moneyness, where the option's strike price is relative to the underlying's current price.
Okay.
Vega tends to be highest for options that are right at the money, or very close.
Why is that?
Because that's the point of maximum uncertainty, really. A small move in the underlying or a change in expected volatility has the biggest potential to flip the option from being worthless at expiration to being valuable, or vice versa.
Makes sense. And if it's already way in the money or way out of the money?
Then Vega usually drops off. If an option is deep ITM, its price acts more like the stock itself, less sensitive to vol changes. If it's far OTM, it's already likely to expire worthless, so changes in vol have less impact on that probability.
So ATM is the sweet spot for Vega sensitivity. What else? Time must be a factor.
Huge factor, time to expiration. Generally, the longer the time until an option expires, the higher its Vega.
More time, more Vega.
Yep. Think about it, with more time, there's just more opportunity for volatility to actually occur, for the underlying price to make a big move. That uncertainty over a longer period means the option sensitivity to changes in expected volatility is greater.
And as expiration gets really close,
Vega collapses, especially for those ATM options. In the last few days or weeks, there's just less time for volatility to matter, so the option sensitivity to it plummets. Time decay, theta, is working hard then too, of course.
are there other relationships? Like, does the current level of IV affect Vega?
It can, yeah, although it's not perfectly linear. Sometimes when IV is already extremely high, the Vega might be slightly suppressed compared to a lower IV environment. But generally, higher IV often comes with higher Vega, especially moving from low levels.
Okay. And any link to other Greeks? Like gamma?
Definitely a connection there. Vega tends to be high when gamma is high. Remember, gamma measures how much delta changes when the underlying price moves.
Right, the acceleration delta.
Exactly. And both gamma and Vega are typically highest for those ATM near-term options, where small moves have the biggest impact on probabilities and sensitivities. They often peak together.
Okay, so Vega is clearly tied up with implied volatility. But let's maybe tease them apart a bit more. Can you clearly define the difference between IV itself and Vega?
Sure. Implied volatility is the market's forecast. It's the level of future volatility that's baked into the option's current price. It's what makes the theoretical price match the market price, and it's always a percentage.
Like, the market thinks the stock might swing up or down by, say, 30% annualized.
Exactly. That's the IV. Now, Vega isn't that forecast itself. Vega measures how much the option's price will change if that forecast, the IV percentage, goes up and down by 1%.
Ah, okay. So if IV is the expectation level, Vega is the dollar impact of a change in that expectation level.
Perfect way to put it. Vega is the output sensitivity, how much the option premium reacts if that input changes.
One's the reading on the market nervousness meter. The other is how much your options value jumps when the needle on that meter moves. Vega.
That's a great analogy. Yeah.
Okay, cool. That distinction helps.
Okay.
So knowing all this, how do traders actually use Vega? Why is it practical?
Well, it's super practical. First, just basic risk assessment. Looking at the total Vega of your option positions tells you straight up, are you positioned to benefit if volatility increases, or will it hurt you?
So you can see your overall exposure to vol changes. A positive net Vega means you want IV to go up. Negative means you want it to go down.
Exactly. And that leads directly into strategies designed to trade volatility.
Like what?
Well, if you think IV is too low, maybe before earnings or some big event, you might buy options specifically to get long Vega. Think about buying a straddle or a strangle.
Buying both a call and a put.
Right. You're not necessarily betting on direction, but you want a big move or a big spike in IV. If IV increases significantly, those long options gain value from the Vega effect, even if the underlying price hasn't exploded yet.
So you can profit just from the expectation of movement increasing.
Potentially, yes. And conversely, if you think of IV is artificially high and likely to fall maybe after the event passes, you might sell options.
Selling a straddle or strangle.
Yep. That puts you short Vega. If IV then decreases as you expect, the options you sold lose value, partly due to Vega decreasing, which is profitable for the seller, assuming the price doesn't move too dramatically against you, of course.
So you can actively bet on volatility rising or falling using Vega. What about hedging?
Vega is critical for hedging too. You might have a core stock holding but want to protect against volatility risk, or maybe you have a complex options position. You can add or subtract options to adjust your overall portfolio Vega, maybe aiming for Vega neutral.
Vega neutral.
Yeah.
Meaning you try to make it so changes in IV don't really affect your overall P&L?
That's the idea. You isolate other factors like delta or time decay theta by neutralizing the impact of volatility shifts. It's a more advanced technique, but Vega is the key metric you'd use.
Interesting. Any other uses? Maybe for spotting opportunities?
Yeah, kind of. But you can use Vega as one piece of the puzzle when assessing if an option seems, let's say, expensive or cheap relative to its volatility exposure. If an option has incredibly high Vega compared to others.
It might mean the market is pricing in a lot of expected volatility already.
Exactly. And if you disagree, if you think vol will actually stay calm or fall, that high Vega option might look like a less attractive purchase or maybe even a potential sale if your strategy allows. Low Vega, conversely, might suggest less vol premium is priced in.
So it gives you a feel for the volatility risk premium in the price. Good stuff. But Vega isn't static, right? What are the main things to keep watching out for?
Definitely not static. That's maybe the most important thing. Vega changes all the time. As the underlying stock price moves, as time ticks away towards expiration, and as implied volatility itself goes up or down, the Vega you calculate now won't be the same Vega in an hour or tomorrow.
It's dynamic, like all the Greeks, really.
Absolutely. Also, remember the effect isn't always perfectly linear. Vega gives you the theoretical change for a 1% move in IV, but a huge 10% jump in IV might not result in exactly 10 times the price change predicted by the initial Vega. It's an estimate.
Good point. An approximation, especially for bigger moves. And remind us again, which part of the option's value does it affect?
Only the extrinsic value, the time value. It doesn't touch the intrinsic value. Keep that straight.
Got it. Extrinsic only. Now, you mentioned sometimes high Vega across the market can mean something, like broader sentiment.
Yeah, it can be a bit of an indicator. When you see Vega getting pumped up across lots of options, especially index options, it often signals rising market anxiety.
Like before a big Fed meeting or during a market correction.
Exactly. People are paying up for protection or betting on bigger swings, which pushes up IV, and therefore the Vega sensitivity becomes more pronounced. High Vega can reflect market fear. The VIX index is basically built on this principle, tracking IV on S&P 500 options.
The fear gauge.
Mm.
Makes sense. Low Vega might suggest complacency.
Could be, yeah.
Okay, to really hammer this home, can we walk through that AAPL example again, just step by step?
Sure. Let's say Apple stock is trading right at $225. And we're looking at an at-the-money call option, strike $225 with 3 months left until it expires.
3 months, ATM call.
Let's say the current implied volatility is 25% and the option premium is $10 per share, so $1,000 for the contract.
Right.
And crucially, let's say the Vega for this specific option is 0.20.
0.20. Got it. Now, what happens if, say, market nervousness picks up ahead of earnings and IV jumps?
Okay, let's say IV increases by 5 percentage points, from 25% up to 30%.
All right, plus 5% IV change.
With a Vega of 0.20, we expect the option price to increase by $0.20 for each of those 5 points. So 0.20 times
Right.
5
Is $1.
Exactly. The option price should theoretically increase by $1 per share, so the premium goes from $10 to $11 per share.
Which is $1,100 for the contract, up from $1,000. $100 profit just from the IV spike.
That's the theoretical impact of Vega, yes. The increased expectation of future movement made the option more valuable.
Wow. Okay. Now, what if the opposite happens? Earnings come out, it's a non-event, and IV collapses.
Right. Let's say IV drops by 5 percentage points, back down from 25% to 20%.
Okay, make a 5% IV change.
Same calculation, but in reverse. Vega of 0.20 times a 5-point drop.
Is a $1 decrease.
Yep. The option price is expected to fall by $1 per share, from $10 down to $9.
Making the contract worth $900 instead of $1,000.
Mhm.
So a $100 loss just because volatility expectations came down.
Exactly. It perfectly illustrates how Vega represents that volatility risk or opportunity, depending on which side you're on and which way IV moves.
That example makes it crystal clear. Okay, as we wrap up our deep dive on Vega, what's the main thing people should really take away?
I'd say the core takeaway is Vega is your gauge for volatility exposure and options. Understand it, and you can better manage risk and potentially position yourself to benefit from expected changes in market uncertainty, whether you're buying or selling.
It's a tool you really can't ignore if you're trading options seriously.
Definitely not.
So here's a question for everyone listening. Thinking about Vega now, how might that change how you approach trading around big known volatility events like earnings?
Yeah, and building on that, what strategies might you explore now? Maybe look into those straddles or strangles we mentioned, or even consider ways to become Vega neutral if you want to focus purely on direction or time decay.
Lots to think about.
Understanding the whole picture gives you much more control and insight into your options positions and risk management. Exploring how Vega works within specific strategies is also really illuminating.
Great advice. Well, this has been a fantastic exploration of Vega. Thanks so much for breaking it down for us.
And that concludes our podcast on Vega. Thank you, Adam and Isla. If you enjoyed the podcast and found the content helpful, then please like and subscribe to this channel to stay updated on when we release the next podcast episode. Thanks for listening.